Welcome to the weekly update, where I'll go over the action in the market for the week of October 27th through the 31st, and we'll see how things look for the week of November 3rd through the 7th. Okay, we did end up having an up week. Now, we gave back a lot of gains, and on the daily side, we're seeing some internal weakness starting to come in. And then later on in the video, I'll show you this thing called a Hindenburg Omen, which the perma bears love, and they're probably all salivating over right now because, as the name implies, it's not a very positive thing. And we got the initial signal, and now we got a confirmation. We've actually had a couple of confirmations. So this is something we need to pay attention to. We need to watch the other charts and see if things are starting to develop into more of a decline on the daily side. But right now, things are still looking pretty good on the weekly side. Even if we have a pullback, we'll evaluate things if that happens. But we're looking okay in the bigger picture when you go through the charts here. Now, what we'll do is just kind of look things over, reevaluate things on a day by day basis. I also do videos every day that you're more than welcome to check out. In fact, encouraged to do so. I do have a website where you have immediate access to the videos. I delay them on YouTube and Rumble. So, and it's free until the end of 2025. So if that is of interest to you, the link is right below the video here that'll take you to that site. Now you have a couple of different choices. You can, if you sign up for the full program, which is free, unfortunately through Substack, you still have to provide payment information. Okay. Well, if you don't like that, there's another site that I set up called spxvideos.com. You don't get access to everything there, but you do get access to the videos immediately as they are available. There's some additional things that I keep on the website that I try to keep that locked down a little bit more. There are trade ideas and things like that. I just don't want that floating out there, especially if I am new to you and you're new to me. Because I don't make recommendations. I make suggestions. You might want to look at this. You might want to look at that. But ultimately, I don't tell people what to do. I'm really big on critical thinking, where I'm trying to give you the best information I know how to give, and then let you fall back and regroup. Maybe look at what I'm concluding with what I'm doing, and then you take that and turn it into your own idea from there. Okay, so now for the week, though, we were up 0.71%, even though we did give back some of those gains, and we were above average with volume, and we are still looking okay in the bigger picture. We'll go through some of the longer term charts. Now, one thing that's a bit of a concern is that interest rates are going back up. Just a few days ago, we were under 4%. Then the Fed comes in this past week, cuts rates, says, well, we're not so sure we're going to cut them in December, freaks out the market. And ever since then, the 10-year yield has been going back up. Now, it was probably going to go up anyway. That's the pattern that we've seen over the last year or so is the 10-year yield comes down, the Fed cuts rates, and then defying what you would think is logic, the 10-year yield starts to go back up. You would think interest rates would go down with the Fed cutting rates, but that's not been what's happening lately. And so we're watching that. We're at 4.1% now, where we've come up from under 4%, and we'll see if that continues to go up. That may start causing some problems. We're also seeing a little bit, not really a positive trend in the dollar, but we're seeing it hold together for right now. And if that really starts to go up, that could also put some pressure on stocks as well. The stock market likes a cheaper dollar because of conversion rates, and it looks better on the books. And import-export relationships are more favorable to U.S. companies. So they like it when the dollar is actually going down and showing a bit of weakness. A lot of geopolitical things going on right now, both domestically and internationally, but the market's mostly fixated on what happened earlier in the week, that there's supposed to be some kind of a trade deal between China and the US, even though there really hasn't been anything officially announced. It was just some kind of leaks that were coming out, and that gave some support the early part of the week, and then it just kind of fizzled out, was replaced by the Fed saying, well, we might not cut rates in December after all. And that's got the market a little bit spooked right now. And there is some Fed speak that came out during the week as well, pretty much concluding the same thing that Chair Powell said on Wednesday, that, well, we're not so sure about December. And there were two Fed officials that came out and kind of said the same thing there. But earnings are going really well. And that's really what the market's driving off of as we continue to be in a government shutdown. So we're not getting much in the way of government data from economic reports. We're getting some other data here and there. We're supposed to get the employment report. We'll be a month behind there with that one if the government opens back up, but that might get delayed as well. We haven't been getting any real jobs numbers from the government. We'll be getting some other numbers that are outside of the government this week. So we kind of have to piecemeal it together, but earnings have really been driving the market. And then this idea that the Fed was going to cut rates this past week, which they did, and they were going to cut rates again in December, which now looks doubtful. But the market is going to take what Jerome Powell said and develop its own scenario. It's going to be hard to do that without economic reports coming out to really base this new scenario around. Okay, and as far as our trend, now on the daily side, we're actually looking at doing sideways strategies right now. And because we're not trending either in the short or intermediate term. We're still underneath 20 in the long term here, but it's above the moving average and it's going up and it's positive. Now, with the short term and intermediate term on the daily side, the green line is still above the red line. That's still positive. We're just not trending right now. And here we're also positive. So that is still the same and looking more positive in the background. Okay, so for the week, the Dow was up 0.8%. It set all-time highs earlier in the week. The NASDAQ was up 2.2%, and that's really where some of the strength came from. We were up 0.7% with the S&P and the small caps. They like this idea of rates being cut, and so that might be in doubt now is causing a little bit of a fuss in the markets, and the small caps are going back down, at least for the time being. So just some bullet points to go through here. Stocks saw a Sox. How do you like that? Red Sox, White Sox. Saw a strong early week of gains and on optimism around U.S.-China trade developments. That's really what pumped things up early in the week. Mega cap earnings, which have been pretty good. Now, Facebook got taken out and shot, not because of their earnings report, but because we're going to spend all this money in the future and it's not going to come into profits. And so we're going to take you down 13% or so. And then sending the major averages to record highs for the first 3 days. And everything kind of shifted midweek, though the major averages ended on a mixed note. Small and mid caps lagged behind, and early week momentum was fueled by U.S.-China trade deals. That was propping things up, and strong tech leadership. Earnings were a big driver this week. Amazon, Alphabet, which is Google, had really strong results. NVIDIA, they had a conference that really supported some things they want to do. So NVIDIA was leading the way there for a while. Meta, or Facebook, reported midweek and it weighed on sentiment due to higher AI spending plans. They're earning a lot of money. They're just spending a lot of it, and the market didn't like that. So tech, discretionary, were a little bit stronger if you take the whole week together. They started to fade a bit, not so much tech, but we're still having some issues with the growth to value ratios on the daily side. They're just not showing any real strength, but they're not turning negative either. And discretionary to staples, again, hanging out around its 50-day moving average when we look at a ratio of that, while staples, real estate, and utilities ended up lagging. And these are defensive areas, unless you want to think utilities are growth because of AI. But those areas did lag. So it was a more dominant market for being on the offense. But we're seeing things slipping over to a possible defensive type of stance. Now, that could all change early in the week. Some positive news could come out, some real buying could come in, and that could switch. We only go with what we're seeing right now. So the FOMC, they did cut rates 25 basis points or 0.25%. And then this is where things started to rain on the parade. Fed Chair Powell, in his comments, he dampened the December rate cut expectations. Nonetheless, strong earnings, a booming AI investment cycle, that's the real buzz these days, and trade optimism between U.S. and China helped maintain a broadly positive tone for the week. Okay, so, and I show this every week here, we're still in this lower end. We did get CPI a week ago, and we're under the 3%. but we're still above the 2%, which is what the Fed really wants to get to. Now, we didn't get the core PCE this week, and that's what the Fed likes to use for inflation, but we're still down in this lower area right now, realizing that the way things are now and the way they've been for quite a while is not necessarily the way they're always going to be. Things can and do change, and so we just want to be respectful of that. So for the session, the week here, we were up to 4.10%, 4.1 here. We're above that 4.02%. So that's why once we got back above that, especially in Friday's session, is really when we climbed above it. That's when stocks started to see some pressure. Now, we had some pressure earlier in the day, and then we bounced up nicely from that. And then we were going up, looking pretty strong. And then right at the end of the day, we saw some selling off, and we pretty much closed unchanged right at the daily pivot for Friday's session. So this chart has not been updated. It's an employment report specific chart. And same thing with this chart as well. Now, FactSet is still updating their blog. They're not connected to the government. So they're reporting, S&P 500 is reporting net profit above the 5-year average for the 6th straight quarter. So that's positive over here. Looking pretty good. Earnings are doing okay, and the market likes that, and that's what's been driving things. So the update, as of Friday's close, 64% of S&P 500 companies have reported, and 64% have reported, but 83% of those that have reported are above their estimates. And that's what, again, what's been positive for the market. Okay, so here is the chart, and you can see Friday's session here. But we started off, this was on positive news between the US and China with the trade talks. We gapped up, but didn't see an awful lot of movement here in Monday's session. And then we gapped up and then just kind of floundered around a little bit. And then, but we did see some late day buying coming in here, but then we saw even later day selling going into the close. Then we had Wednesday where everyone's just kind of humming and hawing. What's the Fed going to do? What are they going to say? And then right here, this is when Jerome Powell rained on the parade of the markets. It really dropped. Now we did come back up to the daily pivot, so we saw a nice little bounce from that. But that's when things started to shift a little bit, and it was a paradigm shift a bit for the market here. And we actually gapped lower on Thursday and then just chopped sideways. But then we saw some late day selling. This is when we were really starting to turn more negative. And then that was also followed up by Friday, where we had a higher open. I mean, it's like, okay, we're going to go to the moon. Well, we set the high right at the open, and then we ended up going down, going down, going down, and then saw a nice little comeback, only to see that largely evaporated by the time we went into the close. So, yeah, you've got a market that's a little confused right now and leaning a little bit more defensive. So, just looking at the 5 trading days, we had the mid caps and the NYSE as well as the S&P were down just during the 5 trading days, not Friday to Friday, but Monday through Friday, where the NASDAQ 100, and Dow actually ended up being positive during the week. So going back to the beginning of the year, we're still positive with all of the indexes, with the mid caps in last place. And small caps have been showing a bit of improvement along the way here. For some reason, they're not showing up on this chart. But we have the NASDAQ and NASDAQ 100, which are leading things more. So the different sectors, this is positive for the market. For the week, tech is still the strongest sector. It was up the most. That's growth. Discretionary, that's growth also. Now, communication was actually down a little bit. So we would like that one to be up here near the top as well. And then we see more of the defensive areas that ended up being down on the week. Then looking at their scooter score way over on the right-hand side, we still have tech. This is looking pretty solid at 94.4. We like it in the high 80s to low 90s when it's looking pretty strong. Then a distant second is discretionary, and then we have communication in third. We would like discretionary and communication to be doing better than they are right now, but they're still positive. And then the more defensive areas, real estate, and then you have materials in here, not doing good at all. And staples down at a reading of 2, so they're not looking very good either. Okay, so looking at just the 5 trading days with the sectors, we had tech. Energy ended up being up a little bit there. We were unchanged with industrials. Discretionary was down slightly, where real estate and staples and materials, as well as utilities, ended up being down the most on the week. Going back to the beginning of the year, tech is the strongest, followed by utilities. They've been giving back some of their gains. Communication is still looking good in the bigger picture. It's just been showing some shorter term weakness. And then way over on the right-hand side, defensive areas, staples, real estate, materials, energy, healthcare. We would like discretionary to do better, but it's trying to improve, but has been kind of stalled lately here. So if you look at tech, a lot of green here with NVIDIA and Apple were up, but Microsoft ended up being down. Then Google was pretty much driving things in the communication area. Then you jump over to discretionary, where both Amazon and Tesla ended up being up on the week. And then a lot of the more defensive areas, you see an awful lot of red in here as well. So going back through the relative rotation graph, we are seeing a bit of a drop off. This goes over the last year. Communication showing some weakness there. Discretionary, still green, but starting to turn down and to the left where we want it to be going up and to the right. But we're seeing a general improvement here with healthcare, energy, and utilities, and then these other areas that are more negative. So we have discretionary and communication, which are still green but showing some weakness. And then we have tech, which is more neutral currently, and the more negative areas right here. And the areas that are showing some improvement, again, are some of the defensive areas: utilities, energy, healthcare, and real estate. Looking at the indexes, we still have the S&P kind of left of center here, where it had been more right of center for a lot of the year, and then lately it's been shifting more over left of center. Now, one thing that was encouraging is the biggest stocks that make up the S&P, the S&P 100, that is showing some improvement, and that's good for the S&P. We were seeing some improvement with small caps. Now they're starting to trail off. The NASDAQ 100 is picking up a little bit of steam here, but it's still in this yellow area where we have the mid caps. Utilities are improving, but still looking not so good over the last year, and the transports are just not looking very good now at all. So going back over the different indexes, we still have the S&P 100, which are the big stocks that make up the S&P 500. That's positive for the market. NASDAQ 100 is showing some improvement, and we have the S&P a little bit more negative, where some of the areas that are improving but still have a ways to go would be the small caps and the Dow Jones Composite. All right, sentiment. This might be a little bit of a concern here. We have investors' intelligence. These are folks that make recommendations about buy this, sell that. They're getting pretty lofty here. Now, it could still go higher than where it's at. It might come down. They probably got spooked like everybody else this past week with what the Fed might be doing. But this is a pretty high reading. And when it gets above 3, we start really watching this. Well, now we're above 4. So it's even getting a little more extreme there. Now, we were improving with sentiment, but we're still negative overall when we look at this at 35. So we were coming back up here and things were improving and we were going with that. And then Wednesday happened and we started to see a drop off in sentiment here. So it's actually switching a little more negative. And then this is before Wednesday's announcement. The active asset managers just a little bit over 90. They could still go higher than where we're at, but we start paying attention to this when we get above the 90 level. In fact, this one is actually different. It has us up at 100. Okay, there's some discrepancy between these two charts. They should be saying the same thing. Then when we look at the VIX, it's still below 20, and that's good. But it is creeping up a little bit here, both with the line chart as well as the bar chart. And we're not really fitting into the seasonal pattern for the VIX. We should have typically seen the VIX go up in August, September, and possibly into early October. Well, we didn't see that. Stocks were going up instead of down. Are we going to flip-flop and do the same kind of thing as we try to finish out the year? We're in a really positive seasonal time, but as I said over in the daily video, do you think the market might throw a curveball just enough for everybody to question, is the market really going to go up after all into the end of the year? It's not necessarily automatic. So the market likes to throw those things at investors at times. So we'll just be watching for that. Still looking really good here with cash to the tech sector. When this is going down, that's positive. That means tech is outperforming. And now folks have got really bearish here, and now they're back down to being a little bit more bullish with the RIDEX bear bull ratio. And we got the latest reading of an individual investors. They're a little bit more bullish. That might drop down now with some of the weakness we saw later on. But this could actually work to the market's favor because there's still more room to go before these folks get really exuberant. And by these folks, I mean you and I. Okay, we're still below the moving average here with the Ulster Index. Not seeing a lot of fear longer term. Not really seeing any fear here with the spread between risky and not as risky bonds. It's been behaving. When we get a high reading here, that means there's not a lot of fear in the market. Now, this has been improving. I stopped showing this in the daily video. When we look at the VIX to the 3-month average of the VIX and do a ratio, this was going back up. And then we had that big down day, October 10th. Well, this is slower, so it moves a lot slower. And this has actually been starting to come back down, showing some improvement. And we're not seeing an awful lot of fear in the VIX, at least yet. And we're still going down for the most part with our long-term moving average of the equity put call ratio. And that's positive for the market. Now, don't have an awful lot of economic data here. We do get this. This was updated here. Not seeing any real changes on the weekly chart here. And the Chicago national financial conditions still under the black line. That's positive. But we did get the Atlanta Fed GDP now, still coming in at just a little bit under 4%. And so this is still looking pretty solid for big growth here with GDP. And then the New York Fed staff, they're coming in quite a bit lower at 2.26, but it's still positive. Now, this was not updated because we need the employment report for that. Now, this chart was updated. The smooth U.S. recession probabilities, we are coming up a little bit here. We're just a little bit below this black line. Now, we're going to get a little bit nervous if this thing still starts to go up. This is a little bit higher than what we were seeing last time this chart was updated. This chart was not updated either. It's another government report situation. Then the inflation nowcasting kind of leveling off. We had CPI a week ago, but we didn't really have any inflation news that came out this past week. So this is where things really changed. Now, as of Friday's close, there is a 63% chance that the Fed's going to cut rates in December. The October meeting is now off the calendar. We don't pay attention to that one anymore. Now we're focused on December. And there's a 37% chance that rates are going to stay the same. This was the big change. Now, where we are with the dark blue, that's where the market thinks right now. Then you have a day ago, a week ago, and a month ago. You can see how much more the market was pretty much figuring there was going to be another rate cut. That all changed on Wednesday. And you can see the probabilities of rates being where they're at right now of really going up over the last couple of days. So that was a big shift in the market. Then now we start looking out to the January 28th meeting. We go out into 2026 for that. And we're getting kind of the gambit here, where we're going to be the same 25%, lower, almost 55%, and even lower than that, almost 20%. But these are going to change an awful lot between now and then. And you can see they're jockeying around here quite a bit as they're trying to figure out what's going to happen with interest rates down the line. Now, the Fed balance sheet is continuing to drop off here, but we're still seeing it going up on a year-over-year basis. Figure that one out. Only a government chart can do that. But we're not seeing much of a change here with the overnight reverse repurchase agreements. Still not really doing all that much. Still huddling along the black line there. Now we switch over to our charts here. We're doing okay. We did set a new high based on price with the advanced decline line as well as volume. But we saw that kind of dropping off later in the week. It would have been much stronger had we finished the week as strong as we started the week. But we're seeing a bit of an expansion here of the new lows and a bit of a contraction of the new highs. So we're still going down with the 5-week chart as well as the 10-week chart. And we're flat here with the advanced decline ratio and still above zero. That's still positive there. As far as our trend, we're above the moving average, but we're still below 20. That means it's a non-confirmed trend, but it is positive with the green line going up and the red line going down, where we're getting into a trendless environment over on the daily side. And the Arun is still looking quite positive here. A lot more buyers than sellers. That is positive. Now, we're getting a reversal signal on the mass index on the daily side, and that's signaling a reversal to go down. We're not getting any kind of a signal here. We're actually going down here. We need to be up around the red dash line and the blue line for a signal to be generated. Now, looking at the S&P, this is the daily chart. Notice how we came up to this pivot point here, this dash line. And that's just about where we topped out. And now we've been coming back down just a little bit. But in the bigger picture, we're still in an uptrend. We're still well above the 50-day moving average. And the 50-day moving average is above the 200. So that is still positive there. And we have been above average with volume. And we switch over to the weekly chart, going up here and above an advancing moving average. That's still positive. Then moving average crossovers here. The blue line is above the red line, price is above both. That is positive. But I'll try to point it out when we get to a chart that's a little easier to see. Also looking pretty good here, but you notice how we closed well off of the highs. We were doing much better earlier in the week. And we're still looking good here. Longer term trend channel going back to 2009 is quite positive, even breaking above the upper end of this trend line. Now, here with the smart money indicators, accumulation distribution, it came down just a little bit. And we're looking kind of overextended here with the boom indicator, but it's still positive for now. And I'm trying to pick out a chart here. See how we opened and then we set a high, and then we closed actually down below the open for the week here. That's the market shifting gears midway through the week. Now, when we look at the chicken money flow, this is actually looking a little more negative. The histogram is going sideways and the red line is going down. We're negative with all three smart money indicators over on the daily side. We're also declining here with the chicken oscillator, and it's picking up some weakness. And we're positive, though, with the vortex. We're also positive on the daily side. And we dropped below zero with the McClellan oscillator. We're also negative over on the daily side there. So we're starting to chop around, but we're still above zero with the summation index based on price and volume. But see how it's been really choppy lately, not showing an awful lot of conviction? And then the bullish percent index, we're negative on the daily side, and we're in danger of dropping below 50. We're at 50.2, and that's the same reading that we're getting on the daily side. But this going down, if it drops below 50, that means there's more point and figure sell signals that are being generated in the S&P than there are buy signals. We're just barely hanging on there. And we're dropping below zero with the swing trading oscillator based on price, but we're still declining here, but above zero based on volume. We're negative across the board on the daily side. Now, momentum is still looking positive. With the PMO, we're above the moving average here based on price and volume. Where we're seeing the momentum oscillators on the daily side are positive. We're just seeing some internal weakness when we break it out based on price and volume. So we're seeing a bit of a decline here with the PMOs that are rising. The buy signals are below 50 and going down, and we're continuing to go down with the PMOs that are above zero. So you can see some weakness starting to come in here. Now that could get taken care of if there's a lot of buying that's coming in, but this could also preclude more of a decline than what we've seen. And we're still looking positive here. We were actually outside of the upper Bollinger Band there for a while, but then we closed down below it. Now here's the momentum, and we're still getting a mixed picture here. We're going down with the slope oscillator and up with the TSI, the True Strength Index. These are both short-term, and they're contradicting each other. Now, we're still looking pretty good with our three intermediate-term oscillators, and we're positive with our long-term oscillators, but we're still negative with the Copic curve. We're also negative over on the daily side, even though our other oscillators are looking more positive. We're still positive with the force index, and we're starting to get extreme here with the money flow. We're breaking above this 80 level. That's showing some pretty good strength, and we're looking pretty good here with the Stochk RSI. We're in about the middle on the daily side. This is showing longer-term positive conviction. We're also looking pretty good here. We're just below the 70 level with the RSI based on 14 weeks. Coming down a little bit, but still looking pretty positive with the Williams percent R. Also showing good momentum. And declining, but still above 50 with the ultimate oscillator. So we were up, but not as much as we were the week before. So the 1 week rate of change came down slightly. And we're just kind of chopping along this red line here with the 50-week rate of change. Still positive here with the weekly special K chart. That's long-term positive. And I did update this just on the pure chance that maybe we already put in a high and we're going to go down. You can see this bar. The open and close are right about each other. That's called doji in candlesticks, and that means an indecisive market that sometimes is getting ready to change. We're not seeing that on the daily side. You see it here on the weekly bar. So just be aware of that, but we still have a lot of support below. We could even decline quite a bit and still maintain a positive backdrop for stocks. All right, and then we're still looking really good here with the Heiken Ashi. That's positive. We're positive with the Kagi chart, the Renko chart, and the three-line break chart. So the trend in the bigger picture has not changed. We had enough of an upward thrust earlier in the week to put in a couple of new X's. An ascending triple top breakout that was generated back on the 20th. And that's pretty positive. We're actually dealing with the 6,900 level with the S&P. And we're just barely above zero here with the ease of movement. We're barely below zero on the daily side. And we're still looking okay with the long-term momentum. We're coming up here with the intermediate term. We were doing better, but trailing off just a little bit here with the short-term momentum. And we're still positive, even though this is kind of a scary looking bar. The Elder's Impulse system is still green, and we're still positive with the parabolic SAR. We're still positive with the parabolic SAR on the daily side also. Now, looking back to the daily side here, we are negative with the mid caps. They're just not doing all that good these days. They fell below their 50-day moving average, but all of the other indexes are still positive. And we're negative in the short term now with bonds based on price because we've been going up with the 10-year yield in particular. But we are seeing more of an upward thrust here with the US dollar index, both in the short and intermediate term. And so we're just coming off of setting an intra-week high here. And we did set an all-time high for the week. We just came down and didn't show as much strength as we were seeing, where we're still going pretty much sideways with the mid caps, and the small caps gave back a lot of their gains as well. But the Dow just coming off of setting an all-time high. NASDAQ, recent all-time high here, actually gapped up on a weekly chart. You don't see that as often. We saw it coming up out of the April lows, and that led to some good things after that. We'll see if something like that can happen this time. And the NASDAQ 100 also gapping up here, up pretty solid, looking positive there with the small caps. Now, this is the small cap, the S&P 600, which is a little bit different than the Russell 2000, but this is still in an uptrend, but coming back down to its 13-week moving average. And the mid caps just kind of chopping along, not doing all that great. NYSE coming off, it's doing okay, but not showing the strength that we were seeing before. And all stocks, US and international stocks, this now we're done with the month. So this chart is now completed, and stocks are still doing quite well here. And the FANG index just setting an all-time high this week, but it did come down a bit. ARK is still in an uptrend as well. Now we're heading over into November, one of the stronger times of the year for stocks. Going back to 2021, we've been up 75% of the time with a 4.8% return. That's pretty good. And this is why a lot of folks are just expecting the market to go up. Well, we need to be more respectful of the market than that. If we do see some strength, okay, great, then we'll go with that. But if we see weakness still continuing to develop, then we have no choice but to go with that. You can't say, well, stocks are supposed to go up, so how come they're not going up? That doesn't fit. All right, and then the banks still not doing all that great here. They've been coming down and just kind of going sideways overall. And then we are just coming off of an all-time high with the Dow, where the transports are sideways. We were showing some strength, but then really pulling back with the utilities. Now, the broad market still going sideways with the longer-term chart of commodities, but copper's still looking good, and that bodes well for the economy. But we're still drifting lower for the most part. We actually got into the 50s. We came back up into the 60s, and we're still in the 60 range right now. And the dollar starting to show some strength here, still in a downtrend, both on the daily side and here on the weekly side. If we break above the 100 level with the US dollar index, that might put some pressure on stocks. We'll just have to see how that plays out. And gold, really giving a lot back here. Saw some profit taking last week and this week as well, even though it did bounce up off of the lows on Friday. And silver also pulling back after it had been doing really well also. And then looking at the price of bonds here, pulling back a little bit, but still looking positive overall. The stock to bond monthly chart, this is now completed as well. Stocks are still outperforming bonds. And here's the daily chart of yields where we were going down, and now we're starting to go back up right after the Fed comes in and cuts rates. And it defies logic, but it's what's happening. And then the weekly chart, we're still tending to go up here with the Japanese 10-year yield, which doesn't seem to be freaking out the markets this time. And then you have US rates and UK rates. German rates are pretty much going sideways currently. And then gold is still the best performing asset in 2025, followed by stocks. Then we have commodities, the purple line, actually starting to cross above bonds based on price. And then we have oil and the dollar pretty much neck and neck, even negative. And then the NASDAQ 100 to S&P 500, still looking pretty solid here. S&P 100 just almost skyrocketing up here, even though it gave back some of its gains. This had gone up a lot more had we actually ended the week a little more positive, but this is positive for the markets as well. Growth is still outperforming value longer term. It's more shorter term that we've been having some concerns about. And then gold against the dollar coming down a little bit as gold has been coming back and the dollar's been bouncing up slightly. And gold here, no, this is gold to the dollar. Okay, and then we have gold to the S&P coming down as gold has been seeing some profit taking. I don't know, maybe it'll end up going sideways for a while. The gold bugs are like, buy it, buy it, buy it, because that's what they always do. But we'll have to see. Is gold's big run in the rearview mirror, at least for the next little while? We don't know. But for right now, the ratio is starting to come back down, showing how gold in the short term is underperforming stocks. And then this is still positive for the market. Low volatility versus the S&P. This ratio is still going down, which is quite positive for the market. And bonds are still underperforming stocks longer term. We still see energy underperforming tech, and that's positive for the market as well. Discretionary still outperforming staples longer term. It's more the shorter term where we're having some issues there. And small caps continue to underperform the tech sector. They see a little bit of hope, and then something seems to happen, and the small caps start falling back. Now, they had an okay day on Friday, but overall, when you compare it to tech, they're really underperforming. Then long term, here's the NYSE just not really moving around, actually turning a little bit more negative recently. Now, the ZWAG NYSE breadth thrust, that did not get confirmed. We had to have a move up here above the red line by October 24th. That did not happen. And so this is not a ZWAG NYC breadth thrust. Now, it could still be positive. Now, we're going down right now, but if we get some legs and really start to move up, that's still positive in and of itself. It's just not an official signal. We're still working off of a nice signal that we got back in April, and that's good for a year going forward. Okay, and then we're still here at a -4 with the Zohar check method. We had been improving a little bit here. It's still negative, but it is trying to improve a little bit. And we're still positive here with the long-term chart of the NASDAQ 100 going back to 2009. Still looking good with this ratio. NASDAQ to Dow. Still showing growth is outperforming value. Also, we see growth is outperforming the small caps. The ratio is still looking good here. We are coming down a little bit with the 50-week new highs, new lows, or 50-day. I'm sorry, this is a 50-day moving average. We're still above zero, but this falling back, and we've been seeing this now over the last couple of months. This is some internal weakness that we've been seeing as the market has been shifting a little bit more defensive. And then we're also coming down a little bit, but still positive in the bigger picture with the new highs, new lows for the NYSE. And we're still coming down for the most part here with the 3-month yield. And we're still tending to go up overall with the cumulative new highs, new lows for the NASDAQ. Then seasonally, now we're into November, where the first half of November tends to do well. The only part that does a little bit better is the second half of November. So this is a better performing time of the whole year. And then we look at November going back to 1964, up 69% of the time with a 1.6% return. Then we have a couple of different ways, and you could probably slice it into some of these other areas. I just picked out two. The November to April time period is the most positive time. And we're up 7.1%, 77% of the time. Now, notice this is not 100%. There's still a percentage of the time when we don't go up. It's just when you take everything all together, on the probability seasonal basis, it tends to do better. Then when we go through June to November, we start underperforming. You put the summer months in there, it doesn't do quite as good. We're up 3.4% about 2/3 of the time. Then I just found this right before I started recording, and I'll start including this in the daily video as well. This is before and after the Fed meets, going back to 2008. So this black line is when they make their announcement. We kind of go sideways a little bit here before we often see things picking up. So that might be helpful. We might see a little bit of bumpiness here, a little bit of turbulence before we see clear skies going forward. All right, and then November, looking really good. Whether you go back to 1950, the last 20 years, the last 10 years, or just post-election years. This is one of the stronger periods. July is another strong time as well. And then this also shows favorable seasonality going into the end of the year, as does this chart, showing that positive seasonality. And this is also shows positive seasonality going into the end of the year. So you have a lot of people who are saying, well, it's just going to go up. And I'm not saying it's not going to go up. The perma bears, of course, we're going to have a 50% crash, but But I'm just wondering if the market's going to spook enough people to maybe have them question that it's an automatic that we're going to go up. That's the way it's looking right now. A week from now, I'll do this video again. If we're turning more negative, we might have to reevaluate that. Then we have the Hindenburg Omen here. And here is a description of the criteria. I just look at the chart where we had the initial spike and then it came down. And now for the last couple of days, we've been getting more spikes here. And if you go back to right before the COVID crash, we started to get some warnings before that happened, and things didn't do so well there for a while. We came up out of it, of course. And then right at the end of 2021, we started to get another cluster of spikes here, and things were everybody, we're going up and up and up to the moon and beyond. And then we went into the bear market of 2022. So the more spikes we get over here, the more we need to respect this. And we'll just watch things day by day and see how they develop. But this is more of a bigger picture type of look at things. So thank you. I hope you're having a wonderful weekend. I hope either the Dodgers or the Blue Jays, whichever team you want to win. I'm recording this before Game 7, and so whatever team you want, I hope is the one that wins for you.